Hey everybody, Mitch Wilder here with the Ahead of the Curve podcast, and Micah Frames with me. And today, Micah is going to help us to see, should we depreciate equipment in the first year, or should we expense it? And Micah, how do we know which of those courses of action we should take?
The main thing that you're going to want to look at is just what people will be tempted to do is expense it all in the first year because you're getting that benefit now. It saves you on taxes now. But the main thing you need to do is look at what your income is going to look like over the next 3 to 5 years. You want to widen the event horizon a little bit because you need to look at your marginal tax rate and what your effective tax rate is going to be versus just the sort of immediate savings. So I think to illustrate this, the easiest way is I could have made a prettier chart, but this was the extent of my ability to do this.
I'm sure it'll be very pretty.
Let's see. So just pull this up where it's for 2023, the marginal tax rates.
Okay.
So for this, let me see.
That's
Pull the
actually a
exact
very
numbers.
pretty chart. I see
Oh,
nothing
well,
wrong
thank
with
you. But so once you hit about, if you're married filing jointly, once you hit about $22,000 for your taxable income, you're paying 12%. Once you get up to about $90,000, you're at 22%, et cetera, till you get close to 700,000, you hit the top marginal tax rate of 37%. So let's say that you're making $80,000. Okay, that if you buy a $10,000 piece of equipment, getting to write that off all in the first year, that can seem tempting because that's $1,000 just on the federal side that you're saving on your income tax. And especially if you're cash strapped, that can seem pretty tempting. You get the write off now, you don't have to spread it out over 5 to 7 years or whatever the useful life of the piece of equipment would normally be. And if you're going to stay in that 12% tax bracket for your marginal tax rate for the foreseeable future, then yeah, absolutely expense it now. That can be a good thing. Although I will come back, there is a caveat to where that might not make the most sense. But if you're going to be making, if this is just a really down year for you, or your business is exploding, and next year you think you're going to be making $400,000, well, that rate arbitrage, you're losing a lot of opportunity for writing off the totality of that equipment in the first year when you're at a much lower tax rate.
Makes a
So
lot of sense.
that's the main and initial thing you want to look at, is saying, okay, not just how much am I making this year, but how is that looking compared to what I expect to be making in the next 5 or so years. And because you want to avoid these huge peaks and valleys, and you'll be much better off spreading that expense out if you're going to be in a much higher tax rate for future years.
Now, I've got a question about that though.
Yeah.
So I think as business owners, we a lot of us tend to be optimistic with our growth, right?
That's very true.
So,
Yeah.
but I mean, the way I would look at it is, at least from a logical perspective, I would look at it as, what's my history of growth over the past
Sure.
5 years? Because I think that would give an indication of what the future growth would look like over the past 5 years. Is that a
Sure.
reasonable way to do that, or is there a better way?
No, I mean, that's very reasonable. You want whatever projections you're coming up with need to be based in reality, not just pure
I'm doing
hopium.
50,000 this year, and I will be doing 5 million next year.
Well, and you'd be surprised how many people who have just bought an internet course on how to do fill in the blank, and especially for some online businesses, how much people are like, well, I've lost $30,000 this year, or I've spent 30,000, I haven't made anything, but next year our sales we think are going to be about 2 million.
Yeah,
Like
right.
there's more. So yeah, so exactly to what you said, this needs to be you should look at your historical growth and what you've made historically, and if there's going to be a big deviation from what that historical growth has been, hopefully you've got a basis in reality for why you think there's going to be this huge jump.
Yeah.
So the first thing to start out with is just looking at what you expect to make over future years, not just looking at this year in isolation. There is there's two caveats that I kind of want to throw out. One, and earlier I'd said, if you're going to be making this same amount for the foreseeable future, then yeah, go ahead and take the expense because you're not losing on this rate arbitrage. The only thing I'll say on that is that if you are financing the equipment with debt, sometimes even though that can make sense from a tax standpoint, from a cash flow standpoint, it can get you into trouble
Sure.
because people will be they're front loading the expense. They're taking the tax deduction all in one year. But let's say that you bought a vehicle on a 5-year loan or something. Well, then for the next 4 years, there's a mismatch in you having this negative cash flow on the loan repayments, but you don't have the corresponding tax deduction to go with it.
Sure.
So sometimes people will run into issues, and a lot of people don't have problems with this. They are good at cash flow management. There's no problem. But the same as debt can get anybody into trouble, sometimes that can happen with this, as if they take the deduction all at once, but then they're still going to have a significant amount of debt service outflow. And they're like, well, I don't have the cash. I don't understand, how's my profit show so high? Well, it's because you've got these loan repayments.
Yep.
So that's the first thing, just to look at it from a cash flow management standpoint. The other thing is that this chart is only showing income tax rates. It's not showing, if you're self-employed on a Schedule C, self-employment tax, which
Yep.
is 15.3%. So that can be, especially if you're working with a new accountant or you are expecting your profit to spike up, what can happen is that people will come to us and they're set up as sole proprietorships, and that doesn't make sense for how much money they're making. So the next year we're going to convert them to an S corp. Well, S corps, you don't pay self-employment tax on the profits. So it could be that, let's say you're in this 12% tax bracket again, but you're self-employed. Well, you've got to add 15.3% on top of that. So then your marginal tax rate is closer to 27%.
Right.
So if you are currently taxed as, sole proprietorship, or and you're on a Schedule C, or you've got a partnership that's not taxed as an S corp, and then the next year you think you're going to convert to an S corp, you just want to keep that in mind as well.
Yeah. Well, and I mean, this is, we really just had conversations similar to this right before we jumped on and started recording. I mean, this is the difference between having somebody do your taxes and tax planning, right?
Yeah.
This stuff is not a mystery, right?
Right.
It is math. The great thing is you don't have to do it, right?
Yeah.
Hire somebody like Micah to do it, because it's basic math. There are numbers, there are formulas, there are equations that you don't have to try to figure out, well, what is the best thing for me to do? Because if you're doing tax planning and somebody's taking the variables into account for you, you'll know what you need to do, right?
Yeah.
It'll
Oh yeah,
be
absolutely.
clear as can be what you need to do.
Yeah, and we say this in all these conversations, and it's part of the reason that when I'm saying these, I'll feel a little bit disorganized, because they're, depending on your setup and depending on how the flow of your business is, and comparing it to what we think it's going to look like, it's just these little like decision trees that you have to account for all the different caveats. So the example on, if you're a Schedule C now and you're going to go to an S corp the next year, and that 15% arbitrage that you got to account for with that, that can make a big difference. So again, like you said, this is one of the reasons why we're big on planning throughout the year and working with people, just because there's a lot of things that can pop up that you want to take into consideration.
Right.
And it's hard enough for accountants to keep it all straight, let alone if you're trying to do it on your own, or you've got an accountant who's just handing you your tax return back saying this is what you owe.
Right.
There's, and we say this a lot too often, but there's so much opportunity that can be lost if you're not planning.
Right. Well, I mean, and I love stuff like this because it helps us to see that it's not accidental. It's not like, oops, there's all formulas for this. There's all equations, right? But I mean,
And pretty basic formulas
right,
too, for the
right.
most part.
And you don't have to know them, right? You don't have to learn them.
No.
You don't have to know them. You just, here's the two conclusions. If you do it this way, it's going to be more. If you do it this way, it's going to be less. I mean, that's essentially what it is. And what's interesting to me is like when typically, like, this is what you and I have run into as we've talked to folks that need help with their, with their finances. Their accountant made a mistake. They had a bigger tax bill than expected, right? All of those situations, it's like, we know that at the end of, you have until the end of the tax year to make changes, to make moves, right?
Mm-hmm.
For it from a tax planning perspective. And what always happens is nobody thinks about it from until January to April, right? They don't think about it, and by that time it's too late, you know.
Right. Well,
And the
we were
thing that
talking about it before the call. You know, our flow of when we get people reaching out to us, and is usually when something bad has happened.
right,
It's usually
and it's when
around
it's too late to
April.
fix it.
Right. It's too late. It's too late to fix it. So often we'll get people not in, prevention or trying to be proactive, and want, it's usually they had something kind of horrendous happen and had a huge surprise tax bill and don't know how to deal with it. Usually people come to us after the damage has already been done,
Yeah,
and then we come in and then we trying to fix it. Maybe we can alleviate it a little bit in the past. There might be maneuvers we can do, but mostly they're not wanting a repeat of what they just had with their last tax bill.
right. And here's the thing is, if you had a problem like this last year, the odds are you will have a problem like that again this year. And if you had a problem like that 2 years ago, but not this year, then you've got a 50% chance of it happening this. I mean, because these things just repeat, you know,
Right.
these errors and mistakes, they just repeat,
Well,
you
and for
know.
the clients that we pick up, these things, their income is going up. Typically, these are businesses that are doing well and growing, and not only do they repeat, they get worse if you don't do
Yep.
something about them. Because if you, and granted that when you're making less money, obviously you have less available, but if you think you're hurting when you're in the 12% tax bracket, you've got no clue how bad it's going to be as your business, doubled or tripled compared to the previous year.
Yep.
And if you're not doing any planning and being proactive at all to try to address that.
Right. Well, and I think that, the thing that I wanted to mention is how many times do you go through a year of your life, personally, professionally, where nothing changes? I
Right.
mean,
Right.
it just doesn't
Right.
happen, right? But and those changes, I mean, the a lot of times in finance they call it a life event, right? Those
Hmm.
changes happen all the time, and a lot of times there are tax consequences, positive or negative, for those things. And if
Right.
you, to me, I would rather know about it as it's happening and acknowledge this could be good or bad from a financial standpoint, and know this is how we're going to handle it. If you're always looking backward at a time when
Hmm.
you can now not make any changes, that doesn't make sense. That's why you've got to be doing this throughout the year. And I would say most of the people that at least I've talked to about this, they come on board and it's like, yeah, my accountant didn't ask me any of that, you know.
Right.
I remember I think I told about it in one of the more recent videos. I was like, I had like a kid and got married,
Right.
and they're like, yeah, we had no idea. Well, we already, did this. I'm like, okay, this is not
Yeah.
good. But that happens all the time.
All the time. And when things are changing, you've got these huge, what you're saying, you want to just deal with it up front. You're always going to be playing catch up if you don't.
Mm-hmm.
One of the things, and you don't have the information available to you to know what business and financial decisions you should be making, because you have no, you're on a payment plan from the prior year's taxes because you didn't plan and didn't have the cash flow available to you, and you don't know what the current year is going to look like. And not only does that just cost you money and interest and penalties, you lose a lot of peace of mind, and just there's a lot of stress that causes mental drag and makes it hard to run the business. But you don't know whether you can afford to reinvest in the business. You don't know what you can afford and what you can't. It
Right.
could be that you really want to hire a new staff member, but you actually can't afford to do it, or you can
Right.
afford to do it, and doing so would give you this huge boost to your company. But you can you can either end up making bad decisions, or you can just get kind of held up by this paralysis because you don't know what you can do and what you can't do.
Right. Right. Well, and on that note, we've really gotten into talking about tax planning on this because that's essentially this is a tax planning issue. But what I've noticed is that, like, let's say that it's June of the and you make a mistake in June, okay, and you don't know about it until the beginning of the next year. So you've got 6 months that have gone by.
Mm-hmm.
What
Right.
I've noticed is that that mistake, even if it's unknown at the time, is like compounding month over month, right?
Oh yeah.
And if it caused a 6 month problem, a lot of times it takes another 6 months to get out of it, you know?
Right.
Whereas when you catch it, like if you catch it within a month or 2 months, right? Then it's not as compounded. It only takes a couple months to get out of, or half a month, because it's just not
Right.
as bad. And I
Oh,
think that's the big problem is people just let this stuff, they let it go 12 months at a time. And then they're surprised when it takes them 12 months to dig out of the situation that they got themselves into 24 months ago.
right. And we have clients right now where we aren't able to do 2023 tax planning with them because they didn't do their books at all for the previous year, and it is such a cluster that we're trying to help them with it, but we don't even have the prior year's financials wrapped up because it was so blown up and disorganized and just disheveled. So not only are we don't have the we don't even not we don't have the current year's numbers and baseline, and we don't have the facts with that. We don't even have the previous year because of the financial setup and decisions. It's taking us this amount of time to unwind it
Yep.
to where so people are losing not only on all the bad decisions or potentially bad decisions that could have been made the previous year, but they're losing out on the current year's planning as well, because like you said, those things, it takes time. And that's an extreme example. Usually it's not
Sure.
that bad, but
It
it can
happens.
it can take a while to
Yeah.
fix sometimes.
Yeah, absolutely. Well, I know that situation, when you and I first got connected several years ago, that situation, it took 2 years to get resolved, because
Yeah.
the first year that it happened, I didn't understand the root cause of that problem. And so I let it go the second year because they couldn't explain it to me. And I caught it on the second year, but
Right.
that's the thing is it took 2 years to get into it, took 2 years to get out of, you know,
Hmm.
and I've just noticed that. And we'll wrap up this video here, but the thing is like, the question originally was, should I expense or depreciate equipment? And this is a classic case of it does depend, and that's why you need to be planning,
Yeah.
right? Is because there are contingencies, there are caveats, even to something as simple as, should I expense it or should I depreciate it?
Right.
You know, so yeah, there's a lot to this stuff. We always do all we can to try to make it as simple as possible. But the fact of the matter is that there is planning that needs to take place, and you need to do it in the tax year that you're in and not get so far behind,
Yeah.
because the
Absolutely.
decisions are easy to be made when you have the data. So,
Yeah.
but as
100%.
yeah, but as always, appreciate you sharing these thoughts with us and helping us to see exactly what elements go into making a decision like this, and how valuable it is to have somebody on our side and on our team that knows this, so that we don't have to be the one to figure it all out on our own, which would be, well, that causes the situations we were just talking about. but as always, Micah, appreciate your expertise, and if you have any questions, as always, put a comment below the video. Happy to answer those. And if you like videos like this, you want to learn more, click the subscribe button. And if you need any help or you have questions that you want answered specifically about your business, we've got a link to our calendars below in the description. Go ahead and grab a time with one of us, and we'd be happy to do all we can to answer that for you. And we'll see you in the next episode.